Joining me right now is the editor and publisher of the Gartman Letter, Dennis Gartman. And Dennis, you've been kind of pessimistic, I should say, about this market. Are you changing your tune at all with a rally like today's?
Not really, Trish. I do think that the market saw its high back in a month ago or so. In international terms, the market saw its high at the end of December. If you take a broad look at all the markets, the major industrialized nations. And what bothers me is that the rallies that we have seen have come in on very light volume. The breaks have come in on much greater volume. That is disturbing to me. I'm very bullish about the economy. I think the economy is on track to continue to move higher. I think recession is a long way into the future. The Fed will be tightening monetary policy all year long. But at this point in the cycle, it is not atypical to see money move out of the capital markets and into plant equipment and labor, and I think that's what's happening.
Mm-hmm. And so where does that leave this market? If we're 25,000 right now, you've got a better economy, people are making different decisions. You could also see, I would imagine, a rotation from equities into fixed income as those interest rates get more attractive. So where does that leave the Dow and the S&P come year end, in your view?
I think that it'll be very difficult for the Dow or the S&P to rally more than 2 or 3% from the current levels. I think on balance they will probably be lower than where they are right now. Do I think they'll be dramatically lower? Not really, but I think they can go down 5 or 7% from here. Mm-hmm. I do indeed think that the highs have been seen, as I said, a month ago in the U.S. market and almost 2 months ago in the international markets. So I think the proper place is to have cash on hand, not to be terribly heavily invested. And if you're going to be invested, there's plenty of places that yield some ETFs, closed-end funds that yield 7, 8, 9, 10%. I'd take a look at owning those things rather than being aggressively involved in equities at this point.
Let me ask you about the Fed. We're getting indications. Well, you know, they say they're committed to raising rates, but simultaneously, at least in yesterday's report, a lot of the data, I got to point out, that they were looking at was kind of old. And their concern is whether or not tax cuts, corporate tax cuts, are actually going to be meaningful in terms of the fundamentals in this economy. And they also question whether or not we're really going to get an increase in wages. By questioning those two things, they're basically, you know, leaving themselves some room, Dennis, to say maybe scale back on some of those rate hikes. I don't know as they will, though, because recent data, and again, they had sort of backwards-looking data, recent data suggests we are in a better economic environment. So where do you think they ultimately come out on this?
I think that the Fed chairman, the Fed governors, and the Federal Reserve regional presidents should spend some time wandering about the country to see what's going on. No question about it. Everywhere you go, help-wanted signs are up everywhere. Even here in Southeast Virginia, where we had been very slow for the past several years because of declining spending on military, which is now beginning to turn the other direction. The demand for labor is intense every place. Wages are, in fact, going higher, and they will continue to move higher over the course of the next year. Good. I'm of the very firm belief that the Fed will tighten at least 4 times this year, and I'm really of the belief that instead of seeing the Fed move by 25 basis points, it wouldn't surprise me later in the year that they move one of those times by 50. So I think we're going to take rates rather dramatically higher.
Well,
no,
that
not
might
really.
Be a little much. 50 basis points?
No, not really. No, not at all. I've been around for a long time. I can remember when the Fed moved interest rates from one meeting to the next by 200 basis points. I can remember 3-month periods of time when the Fed funds rate moved by 800 basis points. So we have become inured to the...
You're going back to the 70s.
We need to have a sense of history. Pardon?
Dennis, I mean, 800 basis points, was that in the 70s?
That was in the 80s. It was in the very early 80s. Okay. Yes, and actually it happened twice in the early 1980s as we moved back into and back out of recession. We had several periods of time when interest rates moved by more than 800 basis points in a very short period of time.
Dennis, I always like talking to you, especially when you make me feel young. Thank you.